again to Montgomery Estate Planning Market News Update, and I'm delighted to say this today that we have John Husselbee from Liontrust joining us, and John is head of the Liontrust multi-asset team. So we're very privileged and very honoured to have you with us, John. Just to give you a little bit of background, John has over 38 years of experience of managing both multi-asset, multi-manager funds and portfolios. He joined Liontrust, I think, back in 2013. And prior to this, John founded a specialist investment boutique firm known as North Investment Partners, and went on to become the chief investment officer for them. Prior to this, John was the director of multi-manager investments at Henderson's. And prior to that, he was at Rothschild. So you can see we probably couldn't have a better person today and better qualified person to talk about what we at Montgomery believe very firmly in, which are multi-asset funds and multi-manager funds. So having you, John, today is a real honour, and I hope that your insights will be very valuable for our clients. So we're also joined, as you'll probably see, by Tom Hull from Liontrust, and Tom is our business development support person. So Tom looks after us on a daily basis. So without any further ado, I'll hand over to Katy, who you will all know as our founder and our financial advisor. And Katy will, I think, go through some insights with John and some questions for John today. So without further ado, Katy, I'll hand over to yourself.
Thank you, Ian, and good morning, John and Tom. Lovely to have you with us today. John, can you tell me, please, what have been the biggest positive and negative issues that have affected the markets this year?
Yeah, good. Well, first of all, morning to you all, and thank you for the opportunity to come and have a chat today. We very much appreciate it, very much on the basis that we always like to talk to clients as much as we can. Expectation management is really the key to having a great working relationship with guys like you, and being able to talk to your clients. It's an opportunity that we'll always take. So yeah, the big sort of negatives and positives, probably all around the same subject, really. I think if we go back to the beginning of the year, beginning of the year, I suppose, when you're thinking about the economy, with the way that central banks, Bank of England, Federal Reserve, they are central banks, the way that they basically put their foot firmly down on the brake in 2022 in terms of interest rates, the biggest rate hikes that we've seen for many a year, many a decade, really, and putting interest rates up to 4 or 5%. Basically, as a result of that, the opinion was that most people, economists, fund managers, commentators and the like, felt that a recession was imminent. And we really haven't seen that recession at all. We've seen inflation continue to rise to a point, and then we've seen it's basically starting to come off, as again perhaps central banks and commentators have felt. When we talk about inflation, we've got to talk about two parts of inflation. There's headline inflation, which includes the likes of food and oil prices, and which tend to be quite variable. And then we've also have core inflation. So headline inflation started to slow a lot quicker, and core inflation now is starting to come down. So, how do you add all these things up? If you've got basically central banks which are continuing to raise rates, and the last time they did it was in September, and then you've got inflation falling, and you haven't got a recession, where are we now in that respect? Well, we're in a situation where central banks are probably fearing the fact that if they take their foot off of the brake, then inflation will take off again. So in terms of all of this, we've had good news and bad news. And I would say that it sort of neutralized itself out to the point that if we talk on average, and it's the only way we can really talk, because I can't talk about everybody's individual portfolio. But if I think about a standard cautious portfolio, that post-COVID, it's sort of got to a peak valuation the back end of 21. So December 21 was probably the peak in valuation. 22, as inflation took off, interest rates basically rose very quickly. We saw valuations fall to around about October last year. We've seen a recovery, and this year because of the sort of good news, bad news, sort of negating each other's out, we've basically seen a sideways move. If you want to think about it in a sort of in terms of mountains, the way I've been describing it is very much, Table Mountain down in Cape Town there, portfolios has been moving across sideways as the expectation is, well, what happens next to central banks? Do they hold? In other words, do they not raise rates or cut rates? Do they raise rates further, or do they cut? And that's what everyone is hanging on today.
Thank you, John. Very helpful. With cash savings rates being more attractive, why should our clients continue to invest?
I mean, I think this is, as a consequence of last year, where interest rates for the best part of a decade were near enough zero. I mean, that. I'm sure you've been talking to your clients about that for the last decade or so. But within a 9-month period, we suddenly normalized, I would say, in terms of interest rates. What is normal? Well, if you look at a long-term average over a 50-year period, you get yourself around about 4.5%, and obviously, clearly, that's where we are today. We haven't really had to tackle that question of cash for a very, very long time. In fact, the last time we probably had the questions on cash was 2007, 2008, which was prior to the global financial crisis. But even then, when we had that question over the last 10 years or so, it's been so low that basically inflation has exceeded it. So when we talk about a real rate of return, we talk about a rate of return after inflation. And cash has given you a negative rate of return for the last decade or so. And to be fair, it's still giving you a negative rate of return as well.
Yep.
But the question on whether to invest in cash or not is basically goes right back to your time horizon, right back to basically why clients come to you in the first place to get and seek financial advice in terms of what are they going to do with their savings. At the end of the day, the biggest danger, the biggest enemy to savings is inflation. If you have short-term needs, I'm pretty sure that basically you will not be advising your clients to go anywhere near risk, anywhere near the sort of equity markets. However, if your clients have a longer time horizon, and here I'm sort of talking about 7, 10, 15 years, then over those periods, and again, we have to sort of use that sort of compliance caveat, but based on the past, if you want to basically get performance and returns to grow your wealth creation, then equities, the stock markets, have given a real return over many years, greater than cash, greater than bonds. So it's all about your time horizon. I mean, it's great to have cash in the portfolio when things are declining. But actually, if you have too much cash in the portfolio when things are rising, which they typically do over time, then it's a real drag.
Yeah. Thank you very much, John. Why are risk-targeted multi-asset funds still a good way for our clients to invest?
I think it goes back to that risk equation as well. So, you sit down with your clients on not only when they come to you on the first time round, but on a regular basis, and you go through this exercise, which is suitability. So, making sure that they have the appropriate advice and therefore invested in the appropriate products as well. So suitability is a way, multi-asset is a way of delivering suitability. Multi-asset portfolios provide diversification, and that diversification allows you to be invested in equities, but then diversified across other asset class, be it bonds, alternative investments, property, all those sorts of things, in order to make sure that we can build portfolios in line with your clients' appetite for risk. It's not only their appetite for risk, it's how much risk they can take. I think what multi-asset portfolios do, and we very much work, as you know, in partnership with you guys, is it allows you not only that suitability argument, but it also allows you transparency. What we're doing today is transparency. You're talking to, I head up the team. There's 5 in the team, further 3 in support in terms of our investment support as well. And it gives you that full transparency, expectation management going forward. And we like to think we're delivering that at a fair price.
Yeah. Lovely. Thank you, John. What would your single best piece of advice be today to investors?
Yeah, I mean, look, today we're living in a world which basically we've got economic, social, and more recently, plenty of geopolitical uncertainty. We've got elections coming up as well, and I'm pretty sure that what is going through people's minds in that respect is what should I do? And I think the best answer I can give is stick with it, stay the course. You've got your hard-earned cash. You can spend some of that, you can save some of that, but at the end of the day, you've got to look to grow it and grow it in line with inflation. The secret to wealth creation is compounding. The only way to compound is to be in the markets. We know that there are good days and we know that there are less good days. But over the long term, if you want to basically put the odds in your favor, then the longer that you invest, the longer you stick with it, then that gives you the better opportunities in order to grow wealth over the long term. People say, well, why don't you do some market timing? If you think today's a good day, why don't you put some more money in? If you think tomorrow is a bad day, why don't you take money out? Well, we're dealing with the future. No one really has a crystal ball. In the short term, equity markets, financial markets are driven by sentiment, fear and greed, optimism, pessimism. Call it what you want, but that basically is those emotions basically dictate the daily moves in the marketplace. That's a lottery. I mean, that's speculation. That's not investing. What we stick to is basically valuations. Valuations that basically allow you to invest over the medium to longer term. And of course, what we're trying to do is basically within the portfolios have more things which we feel are attractive from a valuation point of view and avoid those things which we think are less attractive because they're overvalued.
Yeah. Thank you very much, John. So what do you think the main issues are for 2024? And what's the overall outlook, do you think?
Yeah, as I said, I think we're sort of table mounted at the moment. I think that sideways moves in markets, and I think I think one of the bigger frustrations is that over a considerable period of time now, a decade or so, when we've seen valuations peak in the past, they've almost come back, within a year or so. COVID, if you remember. Was it March time, something like that? We saw basically valuations fall, and then they came back within a year or so. What we've got today is, if I just take my standard cautious portfolio, as I said, it peaked at the late 21, and we're still basically not back to that prior peaking valuation, and we're moving sideways. So the challenges going forward are still ones of inflation. Is the battle over? And if the battle is over, then when do central banks basically take their foot off the pedal and start to cut rates? When they cut rates, we will have a situation which will be the reverse of 22. What happened in 22 was basically bonds fell and equities fell together. They were correlated, as we would say. And in that scenario, which has only happened once, I think it's 4 times in 100 years, we can go back and find it. In that situation, we did not get any downside protection from diversification. Once central banks decide that they're going to start cutting rates, my feeling is that what we're going to see is basically bonds will rise and equities will rise together. Now, the key question, Katy, is when is that? And that's what I can't answer you. I can't answer you that. I know that we need to be positioned for that. If you think to some extent, think about the garden today. We're in the winter period of the garden. I go out in my garden over the weekend. The grass is not growing. I don't need to cut it. I look round the borders. I pulled all the weeds. I don't really need to do any more of that. I can tinker around a bit, but is it really going to make any difference to me? Now I start looking at the plants. I think, okay, come the spring, are these things going to bloom for us? Are they going to grow for us? I think that's where we are today. We're waiting basically for the winter to turn to the spring. What is that catalyst? That catalyst has to be a clear sign that interest rates are being cut before we can move forward.
Yeah, thanks, John. I'm tempted to invite you to come and help me with the garden. But in the meantime, what's your best estimate then of where the FTSE will end up by the end of the year? I know that's impossible to answer really, but I'd like you to try.
Yeah, I mean, I think, giving up on I mean, crystal ball, I gave that up a few years ago. When I was first, I mean, I started investing, as Ian said, I started investing when I was 12 years old, but I started in the city in the mid 80s, and I worked at Rothschild's, and, Rothschild's was a fantastic place to do your apprenticeship. And I always remember very early on, basically, when being asked this question, that my mentor at the time said, never give a number, never give a date, never give a number. And perhaps I didn't appreciate why, but almost 40 years on, I do now. In terms of investing, at the end of the day, as I said, it's investment, not speculation. Valuations drive the markets. So sentiment drives it in the short term. So where the FTSE could end up or not by the end of the year is really in the lap of the gods in that respect. However, what I can say is, in terms of valuations on the medium to long term, I think they are a good position to be invested. The only other thing I probably should say as well is that there is such a thing as the Santa rally. And the Santa rally basically happens just before Christmas, rolling into the new year. It's got a great track record of markets rising over that period of time. So, let's fingers crossed, and hopefully we'll get a little rally into the year end.
Thank you, John. So final question, and something that's quite a hot topic all the way around. What impact do you think artificial intelligence is going to have on the markets, maybe in the short term and the longer term?
Yeah, I mean, I think it's a great question. It's certainly topical on the basis that in the first couple of quarters of this year, not so much in the last quarter, we had AI as a theme really driving particularly the US stock market. And when I say the US stock market is the typical gauge or index. We have the FTSE, the top 100 companies in the UK. The typical guide in the US is the S&P 500, Standard & Poor's 500, and as the 500 would suggest, effectively the 500 largest companies in the US. But the reason why the US was positive, or has been positive this year, is not because all 500 have been up. It's only 7 stocks. They call them the Magnificent Seven. The 7 largest stocks in that index have gone up, and they've gone up all on the back of AI. Now, I think it's far too soon to work out who the winners or losers will be of AI. However, when Bill Gates tells me that basically AI is a general purpose technology, a bit like the internet, a bit like PCs and various other things, then who am I to argue with someone such as him? And therefore, I think we are yet to see the winners and losers from AI. And I don't think the winners and losers are going to be in a narrow sector. I think they're going to be in a broad sector. I think everyone stands to win from AI, hence the reason it's a general purpose technology. So even high street stocks can benefit from it. As we go forward, we will work out that basically the extra or higher productivity we get from AI will be a beneficiary or right across the board. So I think AI is not just a specific investment. I think it's a general purpose technology, which we will slowly find out the winners and losers over the next decade or so.
Thank you, John. That's really helpful, very interesting. Ian, is there anything else you'd like to say or ask of John before I wind up?
Just a question, John, that I think if it's on my mind, it's probably on others, that I think it probably is a fair assumption to make that in 12 months' time, we could be looking at a new government in the UK. What impact do you think that will have on the market if Keir Starmer does come into power?
Yeah, I think I think there's 2 things here. Number one is, what you've got elections in the UK and elections in the US. And with all due respect to our mighty nation, when it comes to investing, it is less than 10% of global GDP, and these days it's less than 5% of the world's markets. So in terms of the UK government on these portfolios, the actual effect is fairly minimal. But when you think about the US elections and a marketplace, which basically an economy, which is, more like 25%, 30% of the world's economy, and a stock market, which is 60% of the world's stock markets, that has to be the focus. So either way, governments in the UK and in the US have a challenge. We're going to have the autumn statement coming up very shortly. And, it'll be interesting to see what fiscal support, in other words, what can governments do to try and help this economy along. There have been basically very limited and curtailed in recent years on the basis of inflation. You can't just basically say, on the one hand, central bank, Bank of England, deal with inflation. Rishi Sunak says, inflation is going to come down by half. He cannot basically make that statement and then over the last 12 months start handing out money because it's inflationary. So they've got a real tricky balance, not only the incumbent, whether it's the UK or US, in trying to get the economy going so they can win votes and get into and retain seats, but actually any new government coming in, whether it's the UK or the US, has a real fiscal challenge around them. And it's very limited by the fact that deficits, the amount of money that governments have borrowed since the global financial crisis and haven't paid back. And then they borrowed a whole load more, which they had to, during COVID, and they still haven't paid back. The challenge with all that, though, Ian, is that basically these large amounts of borrowings, interest rates have gone up. And so therefore, to basically pay those interest rate payments, they got to find even more money. And then if you want some real doom and gloom, then you can add in sort of climate change, sort of changing demographics and contraction of globalization as well. So, I don't think at the end of the day that, my typical long-winded answer for you, I don't think at the end of the day that basically a UK government, a change of presidency in the US really has much wiggle room to do anything apart from the status quo, because basically what you're going to have to do is reduce your spending and increase your income. In other words, increase your revenue. So what does that mean? You basically got to try and sort of cut budgets and increase taxes. Well, to me, that's not the most popular move around. And so therefore, I think, as I said, I think it's very challenging to really understand what governments can do going forward. We have a year-ish to run, and the economy will at the moment be centerpiece to all that. But you cannot read the tea leaves in terms of what Starmer's thinking. And every time you hear a headline, see a headline, well, you know why, because it's testing out. It's it's a leak to test out the nation, see what the reaction's like. Let's see what happens on a Sunday morning on the BBC. And see what the reaction is. Oh, it seemed to go down well. Well, let's work on that one and so forth.
Okay. Yeah. Thanks, John.
Thank you, John. Thank you very much for your comments and answers to our questions. Lovely to chat to you. Thank you also, Tom, for your support. And we look forward to chatting to you both again in due course.
I'd love to. That's great.
Definitely. Brilliant. Thank you very much, guys.
Bye.